Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Monday, everybody. I hope you had a restful weekend, and I wish you all a productive week ahead. Today's episode will contain a sponsored feature. The feature will be labeled throughout, and you can skip it if you want. Sponsored features are restricted to only one per month. This is to ensure that the channel is financially sustainable, but still primarily supported by subscribers. If you'd like to know what my policy is regarding which sponsors I work with, please see the description box below. Now let's begin this week, as we usually do, with economic updates. Today saw the publication of the Caixin China General Services Business Activity Index, which seeks to provide an independent snapshot of the operating conditions in industries such as retail and tourism. The services sector accounted for 59% of China's GDP in the first quarter of this year, according to official government numbers. According to the index, activity in China's services sector grew for the 16th straight month in April, but at a slower pace month on month. The index sank 0.2 points in April from the previous month to 52.5. A reading above 50 indicates an expansion in activity. The official services PMI, released by the National Bureau of Statistics last week, dropped 2.1 points to 50.3 for the month. Wang Zhe, the senior economist at Caixin Inside Group behind the index, expressed, quote, "The recovery of the global economy has resulted in an increase in the inbound tourist numbers. This has helped produce the upward trend in service exports." End quote. That's where the good news ends. Next up, in a recent meeting with China's largest steelmakers, Tang Zijun, vice president of the China Iron and Steel Association, warned that China's steel industry is at a pivotal transition and risks, quote, "falling off a cliff," end quote. As Hong Kong-based South China Morning Post explains, China's steel production has increased rapidly over the past few decades, making it the world's leading producer and exporter. Quote, "But the prolonged downturn in the property market and a slowdown in infrastructure spending by some local governments to curb debt risks means the industry is facing a reality check." End quote. Prices have plunged steeply since 2021, and some steelmakers have called for output curbs, citing mounting losses and cash flow risks from overcapacity. Tang told steel industry leaders, quote, "In the past, the steel industry was mainly supported by investments such as real estate, infrastructure construction, and factory equipment renovation. In the future, it will be driven by consumption and innovation-based strategic emerging industries and future industries. The era of large-scale construction in our country is over." End quote. South China Morning Post reports that Tang called for better discipline and allocation of resources, as well as a healthy development of the sector, adding that overinvestment in some products would make overcapacity even worse. He expressed, quote, "The biggest problem now is how to achieve a dynamic balance between supply and demand. If this problem is not handled well, it will have a huge impact on the ecosystem, sustainable development, and international competitiveness of the entire industry." End quote. Tang compared the status of China's steel industry to a field that has been planted with too many seeds, leading to a poor growth of the crop, but, quote, "Now it's difficult to decide which ones to pull out." End quote. This meeting comes as the world has grown concerned about Chinese overcapacity across a bunch of different sectors. This has sparked further political tensions with the US, the Europeans, and others. Indeed, as we will soon see, one of Xi's goals in his European trip is to manage these trade tensions. According to the World Steel Association, China produces roughly 55% of all steel produced in the world. It produces nearly 80% more than the next 9 biggest producers, which are, in order, India, Japan, the US, Russia, South Korea, Turkey, Germany, Brazil, and Iran. But staying on domestic steel overcapacity for now, a new Fitch ratings report warns that overcapacity is likely to persist, as over half of China's steel products are used in construction of property and investment, and both sectors are in a bad way. The report explains, quote, "Although the manufacturing industry has recovered strongly, and there are many star subsectors such as shipbuilding, electric machinery, general equipment, and automobiles, it is still unable to bridge the huge gap in demand for steel caused by the construction downturn, end quote. Adding, quote, currently export products represented by steel are vulnerable to trade barriers on the grounds of low price dumping, and intensifying trade protectionism will pose a challenge to China's steel exports, end quote. Others agree. Quote, China's steel industry has become a stand-in for the overall economy, with growing supply facing declining domestic demand. Fixing this will require some combination of a decline in production, which is bad for growth and unemployment in China, and an expansion in exports, which won't be easy for other steel producers and exporters. So far, exports have taken up much of the slack. An Oxford Economics report measures China's combined export volumes of iron and steel to be 80% above pre-pandemic levels. I suspect many steel producers will respond by protecting their steel industries, but this will be tougher for major steel exporters. End quote. Next up, we discuss Xi's trip to Europe, but now we move on to the sponsored content. We live in an increasingly wireless world, and in recent years we have seen concern for electromagnetic radiation, EMF, become mainstream. From athletes to biohackers to folks trying to optimize sleep to the military, radiation is a global problem and people are waking up to this issue. There's now a company that is gaining massive momentum in offering solutions. Today's video sponsor, American AAIRF Inc., provides savvy investors with an excellent opportunity to take advantage of these trends. American AAIRF Inc. is a consumer-facing public nanotechnology company whose brand, Lifetune, manufactures and distributes wearables and devices that attach to your phone or laptop to protect people from electromagnetic radiation. The company's products are intended to neutralize radiation from electronic devices such as cell phones, computers, microwaves, and Wi-Fi routers, and their product has been a wild success. The company's management estimates that it would require 8 figures, around $20 million US, and between 2 to 5 years to build a product that competes with theirs, thanks to the development of their proprietary nanotechnology that shields customers from negative effects of EMF radiation exposure. This technology features a resonator antenna that captures the charge from electromagnetic fields. There are millions of etchings within the silicon chip, and this is where the massive moat and competitive advantage comes from. Strong sales prove that customers love the product, and they include very influential celebrities like Kim Kardashian and top athletes. The investment opportunity here is that you'll get a great and wildly popular product with a deep barrier to entry and a new superstar CEO, Josh Bruni, who since joining the team has seen sales quadruple. Speaking of leadership, you also have a committed executive team who owns 23% of shares of the company. With 1 in 7 surveyed concerned about electromagnetic radiation, demand for this technology will continue to surge. This is quite the opportunity. Currently, the company's market cap is a little over 100 million Canadian dollars, only 10 times sales, with a very healthy balance sheet and optimistic outlook. It's no wonder that the company share price is already up over 200% over the last 12 months. So, if you're thinking about adding a new firm to a well-diversified portfolio, American AAIRF Inc. is worth looking into. We remember that all investment involves risk. What we've just discussed is not individual investment advice. Always speak to an investment professional before making any investment decision. A big thank you to American AAIRF Inc. for sponsoring this episode of China Update. Now, we remove normal content. Next up, Xi Jinping has arrived in Europe, landing in Paris yesterday, Sunday. Xi is in Europe his first time in 5 years on a mission to ease escalating tensions that threaten to ignite a trade war between the two massive markets. Quote, China is determined not to let its relationship with Europe slide further toward the direction of its ties with the US. There will be a renewed charm offensive from Beijing, but it will equally give the EU tough warnings on trade protectionism. End quote. UK-based The Financial Times writes today that Xi's top priority for his 6-day visit would be damage limitation. Xi, the outlet writes, is intent on countering the litany of trade investigations by the EU into Chinese companies, including a blockbuster anti-subsidy probe into electric vehicles expected to conclude in weeks. EU officials have told The Financial Times that preliminary duties on EVs could be imposed as early as May. while permanent tariffs that need the support of the majority of member states could follow in November. As we have discussed in previous videos, researchers at Rhodium Group, US-based Rhodium Group, said the duties on Chinese EV imports to the EU could range from 15 to 30%. Quote, China cannot afford the closure of the European market to Chinese companies. The main question is how successful President Xi can be in altering the current trajectory on Europe-China relations. End quote. While in France, Xi will meet with Macron and Ursula von der Leyen, President of the European Commission. The former has sought to build warm relations with Xi, while the latter has taken more of an adversarial approach to China generally. Von der Leyen has advocated de-risking Europe's commercial relationship with China and has blamed the EU's huge bilateral trade deficit, €291 billion in 2023, partly on Beijing's limits on market access for European companies. The Financial Times writes that she will warn European leaders that duties on Chinese exports would trigger an uncompromising response, with Chinese analysts telling the outlet, quote, China could impose restrictions on the export of materials needed to make microchips and on French exports to China and several other items. End quote. While the talks in Paris are expected to be challenging, Xi's visits to Serbia and Hungary would strike a much more positive tone. Both nations have built friendly relations with China over the last several years, opening up to Chinese investment. Indeed, some have argued that Hungary has become reliant on Chinese investment. Quote, Hungary is greatly overrepresented in Chinese FDI into the region, amassing more volume in the past 2 to 3 years than in the preceding decades. This is politics. Hungary has been loyal and reaps the rewards. End quote. Of course, Ukraine will cast a long shadow over Xi's time in Europe. European leadership have become increasingly concerned with Chinese support for Russia's war industry. A new study of trade data by the Center for Strategic and International Studies, CSIS, a think tank in Washington, suggests that many of Russia's imports lead back to China. According to the center, firms in China have provided Russia with semiconductors that are critical for making various weapon systems. They have also provided navigation equipment, parts of jets, and more generic products such as ball bearings used in artillery pieces and other equipment. UK-based The Economist writes over the weekend that transaction records suggest that Russian imports of precision manufacturing equipment used for critical hardware largely come from China too. Between March and July of last year, there were more than 10,000 transactions a month from China to Russia involving these tools. Each record could contain multiple goods, so the actual number of machines provided is likely to be much higher. The surge in deliveries from China came in March 2023 when Xi Jinping met Putin in Moscow. China has maintained that it is neutral in the war and does not provide weapons. But, The Economist argues, quote, the export of these smaller items confirms that it is contributing much else to the Kremlin's war machine. End quote. We will follow Xi's trip in Europe as it unfolds this week. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a good Monday, and I will see you all tomorrow.